Hey everyone, it's Matt Donahue with Mission Financial Planners. I hope your week is off to a great start. Last week we had a crazy week in the markets. We got some great updates in terms of tax planning. We're going to continue with our education theme. On top of that, we're hosting a webinar tomorrow. We're going to talk about staying invested in volatile markets. We're going to be joined by Alan Zhang from the Kestra Investment Management team. Kestra Investment Management is one of our primary investment partners, so we're looking forward to their insights there. Let's go ahead, let's jump into it. So from a market moving news standpoint, a lot of growth. Q2 2024 GDP growth came in at 2.8% compared to expectations of 1.9%, and also above first quarter's 1.4%. Consumer spending was a solid 2.3%. Overall, those reports point to less softness than the first quarter report suggested. While the U.S. economy has cooled from its 4.1% pace from last year, growth averaged a solid pace of 2.1% in first half of this year. The jobs report showed a significant slowdown in job gains, growing just 114,000. In addition, 29,000 jobs were removed from the prior 2 months, bringing the 3-month moving average down to 170,000. Unemployment rose 20 basis points to 4.3%, which triggered the SAHM rule, SAHM. That's an empirical observation that predicts recession when the 3-month moving average of the unemployment rate exceeds its lowest level over the prior 12 months. So that's part of the reason we saw that big market sell-off last week. Lastly, wage growth continued to cool, with the July average hourly earnings rising by 0.2% and 3.6% annually. That's the slowest annual increase since 21. So overall, what does this mean? That report's showing a labor market that's cooling a little too quickly for most people's comfort. Profits. The second quarter earnings season is wrapping up. 87% of the market cap has reported. Analyst estimates for pro forma earnings per share are currently tracking at $60.20. If realized, that represents a 10.4% year over year and 6.6% quarter over quarter growth. So very strong rates there. Across sectors, information technology and communication services are expected to deliver another quarter of double-digit earnings growth, while healthcare is expected to bounce back after a challenging first quarter. Elsewhere, some of the more cyclical sectors like industrials and materials are expected to see earnings fall relative to last year. As wage pressures fade and companies focus more on cost management, margins are expected to be the largest driver, of earnings growth. From an inflation standpoint, the June CPI report showed a nice cooling of inflationary pressures. Headline CPI fell 0.1%, while core CPI rose just 0.1%. That brought the annual gains to 3% and 3.3%, respectively. Energy prices fell 2% month over month, led lower by gasoline, while lower new and used vehicle prices allowed core good prices to fall 0.1%. Across core services, shelter inflation rose just 0.2%. That broke a nearly 3-year streak of inflation at or above 0.3%, and auto insurance bounced 0.9% month over month after falling in May. Airfares also looked weak, falling 0.5% as well. So overall, what does this mean? The report's showing that disinflationary momentum is regathering steam, and price pressures should continue to ease throughout the summer. Interest rates. At its July meeting, the Fed voted to hold rates steady at the 5.25% to 5.5% range, which was what was expected. The Fed statement contained subtle but important dovish tweaks, more confidence in the path of inflation, some concern about the soft labor market, and again, that equal focus on inflation and full employment. During the press conference, Chairman Powell hinted several times that an upcoming rate cut in September might be on the table. Given a weaker jobs print following the meeting, markets are now expecting the Fed to cut rates more and at a faster rate this year. Labor market cooling at an uncomfortably fast pace. Hey, that presents some challenges to risk assets. A slow-moving economy is also more vulnerable to any kind of shock, really, and moderating economic growth could weigh on earnings, leaving markets vulnerable as valuations get stretched. Okay, tax update for the week. We'll get to that right after the philosophy update. So philosophy update, what you're looking at this week is, hey, you know what? More of the same. Don't sweat it. Use your reason to get yourself out of trouble, to get yourself out of some of those emotional decision-making processes. So here's the quote. You've endured countless troubles, all from not letting your ruling reason do the work it was made for. Enough already. And again, that comes from our buddy Marcus Aurelius. All right, tax tip. Here's that 529 education plan, and I'm just going to give you some key points. 529 plans are either prepaid tuition plans or savings plans. Anyone can establish a 529, even for yourself. You can do it for anyone too. 529 plans are available for primary, secondary, religious, post-secondary, apprenticeship, vocational, and trade school educational institutions. 529 plan withdrawals can be used to repay student loans. The longer you wait to withdraw the funds, the longer the tax deferral period of the plan. Earnings are tax deferred and tax-free if used for eligible education purposes. Those include almost everything, but amounts are limited for primary and secondary schools. Check your state to determine what deductions are available for 529 plan contributions. Watch out for taxes and the 10% penalty if you take non-qualified withdrawals. Health tip of the week, we're going to stay in the skincare realm this month. So 10 myths about sunscreen. Sunscreen, as we all know, is super important, super essential. So make sure you're using your sunscreen. At least 20% of people are going to get skin cancer at some point in their life. So top 10 myths about sunscreen. It doesn't matter when you go out. Yes, it does. I can't get sunburned on a cloudy, rainy, or wintry day. Yes, you can. I tan but don't burn, so I don't need sunscreen. Well, anytime your skin changes color from being out in the sun, guess what? Your skin took some damage. I don't need sunscreen because I have dark colored skin. Kind of just touched on that. My makeup has sunscreen. That's all I need. Hey, unless your makeup has an SPF rating above 40, it's not really going to help you. Myth number 6, I won't get enough vitamin D if I wear sunscreen. Please. Myth number 7, any kind of clothing protects my skin from getting too much sun. That's not true. Lighter clothing will let more sunlight through. You want to make sure it has an SPF rating of somewhere between 40 and 50 if it's going to do you any good. Higher SPF gives significantly more protection. No, it's more incremental than significant. All sunscreens are created equal. I think we all know that's not true. And sunscreen never goes bad. Sunscreen is typically good for about 3 years, and then you'll want to replace it. That's our weekly update. Don't forget, tomorrow, noon Central, 2 Central, we've got our webinar with Alan Zhang from Kestra Investment Management. Hopefully you can make it. We're excited to host you. Feel free to reach out. Go to our website, www.missionfinancialplanners.com. Register for the event. Feel free to reach out to us if you have any questions. Thanks again, everyone. Have a great week. Bye-bye.